Roche joins us, CIO at Disciplined Funds. Cullen, great to have you here today. So it seems like the market literally had to wait to hear him say no March to believe it. What's the bond market's issue here? How come we couldn't read between the lines?
Yeah, I mean, we're in kind of a screwy period for everything that's going on with Fed funds futures and interest rates in general, because the Fed, I've talked about this a lot in the past. The Fed has to be very data dependent. So they have to be able to justify all of their decisions based on data. And they're still in this point where, inflation is still high enough that there is still an outside risk that they cut rates, it ignites consumption, and you get another bump in inflation. I've been pretty vocal. I don't think that is a remote risk at all at this point, but I could be wrong. And the Fed, I kind of liked actually the way Powell was talking about risk management in a way that, more so the way that someone like myself or an asset manager thinks of the markets. You don't often hear that from a Fed governor. So I like the way that they're managing this. The interesting thing, and this is what makes this environment the most interesting part of all of this, I think, and the Fed's management of all this, is that you have a rising risk of the hard landing scenario here, where we're now seeing material softness across, several segments of the labor market. And the risk of that hard landing scenario now rises, where you could find yourself in, say, June or July in a scenario where the labor market has deteriorated a lot more material than people think. Inflation has come down to target, and the Fed then is being put in a position where they're more forced to lower rates rather than the position they're at right now, which is pretty good for them, where they're thinking of lowering rates on their own volition because things are good.
That's a big difference in terms of what it means for us as investors, right? That's kind of the mystery of the yield curve right now, where traditionally when it uninverts by way of a big bull steepener, that's actually bad news. But as we talked about 6 months ago, and kind of for the most part this past half year, we've been steepening out through a bear steepener. I mean, how much do you think runway we've got here, Cullen, for the economy as a whole before we start to see a bigger rollover?
God, I mean, I still think, I've been saying that we're in sort of this mean reversion scenario where everything's just really mean reverting from COVID as supply chains heal and the economy and consumption is going to, I think, Powell is right, that eventually growth is going to moderate into a more sustainable rate. We're still running nominal GDP of 6%. That's just not going to continue for years and years here, especially with the policy rate where it is. So I think as things kind of normalize, you're in this really tricky scenario now with the Fed where you do have everything looks pretty rosy now, but let's say that some of this labor market data really starts to deteriorate much more so than people expect. And especially with revisions and stuff like that, who knows, you could see a negative unemployment report here in the next 6 months, especially with the policy rate where it is. So, I would still say that the Fed funds market is more right than wrong at this point. Okay. We are going to get rate cuts. We're going to get them, I think, later than, I've been saying this too, that we're going to get them later. Probably the June is my baseline right now. But the thing that would force their hand, and this was another thing that I think is the positive takeaway from the press conference there, is that Powell is very focused on the labor market. So if you see you get a weak employment report this Friday and you get more weak labor market readings across the next few months, May probably becomes that probably becomes the baseline rate cut scenario. And in that sort of a scenario, you're then transitioning more into a scenario where they're not cutting on their own volition. They're cutting more so because the labor market is forcing them to. So then they're going to be sort of backpedaling to try to get ahead of, potentially inflation being much lower. And that's my other, I think, low or higher probability outcome here, is that I think that the risk of inflation being much lower than their target in, say, 2025 is much higher at this point than that sort of double bump 1970 sort of scenario that a lot of people are worried about.
Okay, so deflation for bad reasons, a bigger risk in your mind than reflation. We talked, of course, over the last year about the T-bill and chill trade. Is something like that then still a good approach? or should one extend that kind of safety trade even further to avoid cyclical stuff, maybe short the companies that really depend on a strong economy?
Yeah, I mean, that totally depends on time horizons. I mean, a lot of our asset management approach is so based on time horizons. I mean, for T-bills and things like that, I do think this is a great time to, I mean, the high probability outcome here does look like they're going to be cutting rates. That makes anything in sort of especially the short term to intermediate bond market very attractive at this point, because the risk reward, I mean, the potential for prices falling a lot in the bond market because of rising rates is just a very low probability outcome at this point. So I think for T-bills, for anybody with sort of short term liability needs and things like that, I do think that T-bills, and especially even extending that into, you can go into, for short-term liquidity needs, you should start thinking probably about extending into, say, 1 to 2 year, 3 year notes, things like that, where you're then actually starting to front run the Fed a little bit, and you're starting to lock in some of the rate structure where it is, so that you've got, say, in 1 to 2 years from now, you've got some of that liquidity locked in where you've got a lot of principal stability in those instruments. So, as for the stock market, in my thinking, is just a super long duration instrument that right now, I mean, this is sort of the riskiest sort of environment to be a stock market investor, in large part because, especially if you're thinking very short term with it, because you've got high valuations. We've had a huge run up, and the Fed now doesn't really know what's going to transpire in the next 6 months. So, any outcome is on the table for the stock market in the next 6 months, which makes it probably a higher risk instrument than normal right now.
Maybe that's why we're getting the VIX creep slow and surely off the lows last quarter. Cullen, before we let you go, we only got about 60 seconds here, but give me a thought on the regional bank situation, because that flared up again today. Since we're talking about weak parts of the stock market, what do you think?
Yeah, I mean, arguably the riskiest part of the entire stock market right now, because you've got the bank term funding program that's ending. And so you've kind of got the Fed's they're ripping the Band-Aid off. And we're going to find out, a lot of these regional banks, they've had the last year to sort of take a breather, reposition their balance sheets, try to turn over their loan books. And what you're going to find out in the next year, basically, unless the Fed reinitiates some of these backstop programs, you're going to find out who's swimming naked and who's not. And so, that's probably a segment that is among the riskier components of the entire market in the next 6 to 12 months.
All right. Thanks, Cullen. Great to have you here today.
Thanks,
Appreciate
guys.
your commentary as always. CIO and Disciplined Funds.